Hey guys, welcome. So let's talk a little bit about stop losses. Stop losses are obviously essential to keeping your risk managed. It's part of the whole risk management strategy, the whole risk management package. You shouldn't really go into a trade without a good idea of where you're going to come out of the trade. Now, the exception to that, of course, is if you're investing and you're prepared to risk your full stake. So if you're putting in £10,000, then you're just literally investing in it. Whatever happens, that's your full risk. But we're talking about trading here from a trading perspective. Broadly speaking, there are more than this, but there are four ways of getting involved with stop losses, or four ways of managing your risk, stop-based risk. Number one is premise-based. Now, what does that mean by premise-based? This is the most popular one, by the way, and this is the one that I use probably the most frequently, is that when you go into a trade, you have an idea of why the trade should work. So let's say, for example, we're in a pullback trade. The market is pushing higher, it's pulling back. The premise of the trade is that the market is going to continue to move higher. That's the premise of the trade. That's why we're going long at this point here, or this point here, wherever it may be. We are assuming that it's just a pullback and it's going to push higher. If the market continues lower, then at what point do we say, you know what, the premise of the trade, which was that it's a pullback, is no longer valid and we need to come out? That's the point of a premise-based stop. So if we were doing a pullback, perhaps we would split there. Let's use a different color pen here. We could split the actual drive into segments and say, okay, there's a low, there's the high, there's 50% of the move, 25, 75. Perhaps we would say, listen, if it pulls back more than 50, we're out of the trade. Or we could perhaps use a moving average that comes up and say, listen, if it goes below an X period moving average, whatever that means, depending on the time frame that we're trading on, then we're going to come out the trade. Or, those kind of things. It's just something that tells us that the premise of the trade has changed. Now, sometimes that's a bit subjective. Obviously, in that instance, there's a bit subjective. A pullback could go a little bit lower than the level we had, but you've got to have some framework in. You're never going to be able to capture everything with a premise-based stop. Another way to do it is to put it under a low or above a high if you're going short, or a key level. Now, the caution you've got to have with that, if we assume here that this is our low of the day, the price has come down, it's tagged it, it's come down again, and we've gone long there thinking, this is going to bounce for a double bottom, we're going to put our stop somewhere in this region here. Now, obviously, you've got to weigh up the pros and cons of having your stop too tight. The positive aspect of having your stop tight is obviously you're risking less. You can take a larger position size relative to your total monetary risk, and then you're going to get a better risk reward. But the downside is that you're going to get pinged out far easier on noise. And this is ultimately actually, while we're talking about this, the full game with stop losses is that you want it as tight as you possibly can while still allowing for noise and allowing the market to do its normal thing. There's no point having it too tight or you're going to get pinged out on noise. There's no point having it too wide or your position size is going to be so small you're not benefiting from the move you're looking for. So let's go back to that point. Coming down here, we can just go along. Where do we put it? Now, this is obviously going to be depending on your time frame you're trading, but let's assume this is an intraday chart, a 15-minute, 5-minute chart, whatever it may be. We've got to expect that there may well be some probe under that key level. There is likely to be a test at some point. So there's no point in being too tight. You've got to kind of give yourself a little bit of wiggle room, which is why, actually digressing slightly, if I'm taking this kind of trade, I always wait for it to test first, and then you can be a bit tighter because it's already had the test. It's already gone there. It's already seen, had a little look under there, found no sellers, found more buyers and sellers, more aggressive buyers and sellers, should I say, driven the whole thing back up, and it becomes a bit more of a key level. So even though this is under a low, I put it as a broad premise-based stop position, you need to think about how the price has acted beforehand, depending on how tight you can have it. So in that instance there, we're going to have to put it a little bit under there because we have to allow for the price to flick through that key level first and come back up. We don't want it too tight, we don't want to get pinged out. If it's already done it and it's already put a wick in, it's already put a little bit of a flush in, it's already done a little bit of action under a key level, then we can tie it up. So under a low or above a high or a key level or anything that has proven itself as support or as resistance, we can put it there. Now, a little caveat here is, an X% or whatever, as we talked about, X ticks above or below. You don't want to just below, you want to try and gauge that depending on. Actually, if we move on to a daily time frame very quickly before we move on to the other pieces, if we look at a daily time frame, we probably, because we're going to get less setups on a daily, if we're trading from a swing trading perspective, we're going to get less setups than we are if we're trading intraday, generally speaking. So we want to be giving things the room they need to oscillate around before the trend starts to pick up. If we're right, we don't want to be pinged out. So I always err on the side of caution. In other words, where does my stop have to be? And then adjust my position size to suit, as opposed to the general mistake, which is this is my position size, where does my stop have to be? Oh, I don't like having to risk $3,000 on that trade, or whatever it may be, $300, $30. I don't like having to risk that, so I'm going to adjust my stop. That's flawed thinking. That the way to do it is to say, for this trade, if I look at it subjectively without position size to work, or the premise to still be valid, it can still go to this level. And once I've marked that level and I've decided that the premise is still valid anywhere up to there, I know my stop point. And then I can decide my position size, etc., from that. So that's kind of the way you want to use your premise-based stop. Specific pullback threshold. So we talked a little bit about the push up, the pullback. We might then bracket it and go thirds. We might bracket it and go quarters. It's just a case of mirroring the position that we want to, or sorry, not mirroring, just specifying the position that we want to come out if it's a pullback trade. If it's a double top trade, the same thing. We want to specify the point that's going to do that. If we're fading a key level, how much further through can we go? It's all about this thing. Specific price point. Premise-based is purely down to a specific price point. We know the exact number that we're coming out if the trade is not working. And when it hits that, we're out of the trade. Now, one thing that worked for me very well when I was actively day trading YM futures, crude oil futures, is to have a specific point stop. So that would be based a little bit on the volatility, a little bit based on experience of how the market was moving. So it would be something like 15 ticks. And then what I would do is I would say to myself, that's my hard stop, but anywhere between 10 and 15, I would look to come out of the trade if I didn't think it was right. So I give myself a little bit of flexibility. 15 ticks was a hard stop, very actively scalping this, by the way. 15 ticks was a hard stop, but when it got to 10, I would look and I'd give myself the ability to come out if I really didn't like the trade, if it acted completely wrong. So that was kind of a little bit of a hybrid way of looking at stop loss.